What's going on, guys? It's the Dividend Bloodhound here with yet another investing video, and today we're going to go through my February update for my Freetrade portfolio. If you like what you see on the channel, please hit the subscribe button or the like button for this video for the YouTube algorithm. I'm always trying to promote and grow my channel. If you have a channel yourself and you would like subscribing back, please just hit me up in the comments below and I will get you straight back to you. Right, without further ado and paying homage to the coronavirus, I will get right into it. So actually today we are £95 up, which is rather surprising considering where I was at the start of the week, where I was actually negative £4. So the portfolio has massively well recovered in the time since the coronavirus crisis sort of hit and broke. And then since then we have largely recovered. So since my last update, I've had quite a few stocks added to the portfolio, and I will run you through them now. So we'll start from the top. My biggest shareholding is Boeing. I have 2 shares in Boeing. It is £493 worth. I am currently £23 down against this share, and that is mainly due to the Max crisis continuing and Boeing seeking £13 billion worth of extra financing to deal with the Max crisis. The dividend from Boeing, so I've been informed, is borrowed actually, so that's not necessarily the sign of a healthy company. However, I am playing the long game with Boeing, and it's only 4.5% down. I expect it to bounce back in the long term, and I'm certainly talking about holding the shares for a year or two or longer. Next up is 3M, so currently sitting 2.3% down and holding a value of £367. This one was massively affected by the coronavirus in China, because that's where they export a lot of their product to. I actually, while it was dipped a lot more than this, I actually added another share. So as you can see there, I'm still £10 down, but I added an extra share for a little bit cheaper than I paid for my first 2. So I was very pleased with this, and now that has become my second biggest holding. Rolling in at number 3, we have AT&T, a solid dividend payer, as you well know. I have 12 shares of this company at £346 of a value. This has taken a slight dip as well because of a lacklustre performance in the quarter, so I'm sitting £4 down at the moment, which isn't much considering it's over 12 shares and £346 of a value. But investors reacted a little bit lukewarm to the company's performance over the last quarter, and that has reflected in the share price. However, over the long term, I think AT&T is heading in the right direction. Next up is AbbVie. Now, if you look back in my previous videos, you will have seen that I've added another AbbVie share since my last update. Again, this dipped around the same sort of time as the coronavirus went viral, essentially, excuse the pun. It was dipped and it went down about 10% on its current share price, which allowed me to buy in there on the 27th of Jan and on the 3rd of February to really average down my holding. And this is a great dividend payer, and it's already bounced its way back up to only 0.2% down. And people are looking towards AbbVie for a potential vaccine or drugs towards the coronavirus. Right, next up is we have Coca-Cola. £270 worth of holding and 6 shares, and is currently up a whopping 10%. So I am up £23.50 on this company. They had a solid quarter earnings. Nothing really major to report. Coke just doing what Coke does, to be fair, and it is a very safe recession-proof company. So people tend to flock there in times of crisis, I would believe. IBM is next on the list. I have 2 shares in this. Now, this used to be the serial underperformer in my portfolio, should I say. However, it is now currently sitting £21.77 up. It's got a new CEO at the helm, which is taking the company in and giving investors hope of a bit more direction to the company. And Red Hat earnings, which is their acquisition of software, recent acquisition of software that cost billions and billions of dollars, is actually starting to bear fruit now and is actually starting to pay off. When this company was 5 or 10% down over previous months, I genuinely now wish that I had bought more. PepsiCo is next with 2 shares and worth £220, up 5%, again doing particularly well, especially over recent days. Paid a dividend last month, and it is doing particularly well, £10 up, and just doing as it usually does with such a well diversified portfolio of foods and whatever. It is just getting on with the day-to-day business. McDonald's is next, just the 1 share, now worth £163 and sitting 9% up. Still has quite a heavy debt burden, I would say, but investors are starting to come back to the company now after the scandal that they had with their CEO being sacked and poor earnings. Down $1.64 today by the look of it. I wasn't quite expecting that, but still £13.10 up overall. Next is Royal Dutch Shell. Now, Shell is one of the companies that have really been hit quite hard by the coronavirus and its effect on global oil demand. So the global oil demand has waned with the lockdowns going on with China. So oil has never really been cheaper for quite a while, which is pretty much affecting Shell's profits. They were down 10%, so they've slightly recovered, but I'm still £11 out of pocket on them. I did actually buy some extra shares, if you see here on the 30th of Jan. I bought 3 extra shares to average down and take advantage of the dip. BP's similarly affected by the... while I'm here, Shell actually had quite a poor earnings report. It's Q4 earnings report. They were down on profit and down on revenue, which also sent investors packing, really. I have strong belief in this company. It's been around for a very long time. It's one of the world's most profitable companies. Even with their supposed lacklustre performance, they still cleared 2.7 billion worth of net profit. So they're clearly not doing too bad. BP is next. So BP was affected by the same sort of issues as Shell in the global oil demand. I actually bought some extra shares in this one as well. Bought some 9 shares on the 31st of Jan for £41. I'm currently sitting £2.50 up on this stock. This is a great income stock as well. Both both Shell and BP pay an excellent dividend yield of 6%. Next up is CAT. Now, those of you who have watched my previous videos that you can see in the timeline next to the video here will notice that I did own 3 shares of CAT just before Christmas, and I sold out for a £50 profit, which I then used to purchase a share of Boeing. And then now I've been paid and Christmas finances have been paid, I've jumped back into CAT, especially since I watched its share price decline quite dramatically over the excuse me there while I move that down, quite dramatically in the last couple of weeks or so, due to not wholly unexpected poor earnings as the global economy slows a little bit, but the China crisis and the coronavirus again affecting their sales. Their earnings were down a little bit, but their actual profit per share was up. So they've found a way to be more efficient with the money they make, and they're actually making more profit per piece of machinery that they shall we say, but their revenue overall was down. So I treated myself back in there. It is one of my favourite companies. So I jumped back in with Shell at £102 a share, and I'm currently sitting £2.10 up. Commercial property is sitting down 3.6%. I own 42 shares and £46 worth. This company has been like trending downwards now for quite a considerable time, but I don't expect it to go any lower than £1 really. And it offers a good solid monthly return. They own bricks and mortar as its commercial property, so I don't expect them to decline too much further, and I'm happy to just drip feed my dividend into here as they're quite cheap to buy a share, and just keep the passive income building along. Once a month I get a dividend from this company. Next up is UNILEVER. I bought these when they're in a considerable dip, when they announced that they had a profit warning and their revenue had declined considerably over the last quarter. So a lot of investors jumped out elsewhere, which provided me with an opportunity to jump in, and I'm currently sitting only for one share because that's all I had, £43 worth, but it's already £2.94 back up again. So next up we have, this is another new joiner since the last update, the S&P 500 Dividend Aristocrats. So I'm sitting 1% up on these guys, just the 50p up, and it tracks the best performing, highest dividend paying stocks in the S&P 500. And the yield on that is about 2.5% for anybody that is interested. And next up we have Carnival Cruises. This is another one that's dipped considerably, around 10% in the last month or so, mainly due to the coronavirus. I mean, over the last year it's actually down 30%. I believe there's a quick buck to be made in the panic selling of the cruises stock, and I might sell out of this stock again when it's made some money. I might not. Its dividend yield is quite high at 4%, so I might keep hold of it and add to it over time. It's a decision for another day. I'm currently sitting 32p up. Next up is the Euro Stocks High Dividend ETF. So these are high dividend payers in the European stock markets, 30 companies paying the highest yields. This averages about 4% yield, so that's actually pretty good and pretty high, and I'm currently sitting 22p up, having bought this share recently. Legal & General I've kept hold of now for quite a while, and it's been on like a post-election bounce since the election now for a couple of months, and it's stayed at 15% up, which is rather annoying because I don't want to buy any more shares in this while they're at a 15% premium. I'm kind of just sitting and waiting and seeing what happens with this one. GSK is another interesting addition to my portfolio. I bought it yesterday, and then they decided to announce today that they were going to break the company in two, and hold one side for pharmaceuticals and vaccines and research like that, and then on the other side they're going to have their normal commercialised drugs, etc. So, and your food. So they own like Maximuscle, they own Corsadil mouthwash, that sort of thing. So they're going to split the commercial excuse me, the commercial side up, and then the pharmaceutical side up. I'm not quite sure how this is going to work, and in the future we will have to wait and see. I'm currently 55p down on this news that hit the stock market today, and a lot of investors have clearly decided it's not for them. However, GSK have had a really strong quarter and posted billions of pounds worth of profit. So it'll be interesting to see what happens to this and what will happen to me and others as a shareholder in the short term while the company does this. Now, this is apparently happening over the next 2 years. It's going to take quite some time to happen, and I assume in the meantime you're still going to be able to buy shares. And take advantage of the turbulence, really. The company is certainly not going to be going anywhere. If that means that there's a stock price reduction for quite a bit, I might certainly take advantage of that. So yeah, back to HSBC. HSBC is still dealing with its issues with its links to the Chinese stock market, really. It's only 40p down against the 2 shares that I own. I would certainly be looking to buy a few more shares of this one as the coronavirus sort of intensifies, and then as it recovers, HSBC should recover as well. And last but not least, we have Balfour Beatty with 2 shares, and a very recent purchase just because I had some spare change. I wasn't really sure where to put it. But I did a little bit of research and found that Balfour Beatty is a prime contractor for HS2, and I expect that HS2 will be given the green light once again by the government in the next couple of weeks. So over the long term, Balfour Beatty is going to be one of the prime contractors for building all the stations and a lot of the infrastructure that goes along with HS2. So that is going to benefit the company massively over years and years and years. So having a spare fiver, I just decided to buy a couple of shares. Now, with so many additions to my portfolio in the last month, I've actually managed to reduce my watch list down a little bit, as you may have seen. But there is still plenty kicking around on there. So we have Pfizer, currently dipped 3.5%. So it'd be worth looking into them if I had any spare money. Lockheed Martin still performing strongly, gone up about $20 since I've been watching them. They're obviously quite an expensive share, as you can see, so it would take me a while to be able to afford a share and then some others. So they're on the watch list to be bought at an opportunity when I have slightly more money than usual. Intel still bobbing around in there, doing okay. Surged in the last month, still continue to do so, so I'm keeping an eye on them. We have the global high dividend, as I mentioned on my Instagram page. I plan on diversifying my portfolio with ETFs, about a third of my portfolio into ETFs to fully diversify them and reduce a little bit of risk to my portfolio. And coronavirus sort of gave me a little bit of a hint to do that. Then we have the S&P 500, the staple of anybody's portfolio, really. Yet to add it to my portfolio, but it is there and thereabouts, and I will be adding it very, very soon. And Videographic chips, unusual for me, a massive growth stock really, rather than dividends. And I'm just fascinated to watch where this goes. It's not a high priority for me to buy, but I'm just watching it develop over time. We have Microsoft off to the moon again, as far as I'm concerned. Excellent growth. Hampers the yield. Because it grows so well, it actually hampers its own yield. But it's still a very good company to own in terms of dividend and growth. Apple, largely the same. Dipped back down to, dropped $10 in the last week or so due to coronavirus, and then has bounced its way back up again. We have Bank of America. I'm not going to talk too much about them because I don't really know that much about them. I know they pay a decent dividend yield, but I haven't really done my research into them, so I wouldn't want to give any information away that's not actually strictly true. Amex is currently up reasonably well, same with all the other card companies, to be fair. They're up. Mastercard and Visa all doing pretty well in terms of their growth and their dividend payouts. Looking to definitely add all 3 of these to my portfolio in the near future, mainly because it gives me a bit of a warm fuzzy feeling that most people in the world at least have a Visa card, a Mastercard or an Amex card in their wallets. That would give me my slice of essentially everybody's card purchasing around the world. Everybody has at least one. I have two in my wallet. I don't have Amex, but I have the other two. Biffa Waste Management's made the list because everybody needs their waste dealing with at some point. Not really had much chance to research this company yet, but it's certainly on my list. We've got Raytheon, the defence company. Big defence contracts coming from the MOD in the UK fairly soon, so keeping an eye on them. We have Smurfit Kappa, the recycling cardboard boxes. I mean, that's going to be a big thing as as we continue to try and do our best for the environment. So certainly looking at them, and they pay quite a good dividend as well. Diageo alcohol, everybody likes a tipple, so I haven't really done too much research into these guys. I've just got them on there to watch how they go for a little bit while I do my research. Kraft Heinz has been took a little bit of a kicking again due to coronavirus, and their earnings still aren't looking great, to be fair. Even though this is a stock that Warren Buffett owns and he still continues to own, you can see it's been in almost free fall since 2018, and it's sort of stabilised at $30. It might one day recover, so it might be worth taking a punt on in the long term. Mondelez is doing pretty well by the look of it. I'm keeping an eye on them. They own lots of food companies, your Oreos, Cadbury's, Toblerone. But what I didn't know is they're also a pharmaceutical company as well. So they stand in to benefit from any sort of coronavirus vaccines or anything along that. They're actually almost as big a pharmaceutical company as they are chocolates, which really did surprise me when I did my research. And here we have is Starbucks. Now Starbucks was up at an all-time high of $93 a share, and then they mentioned shutting them 2,000 stores in China. They still remain shut to this day, but the share price, after taking an initial shot down to $83, has gradually recovered. Sainsburys is massively down due to a lackluster Christmas performance, which has sent investors running away really. Even though they only missed by a little bit, they still missed their targets quite dramatically. National Grid is up 6%. That's still up since the general election, when everybody found out that they weren't going to be nationalised. Colgate and Palmolive doing well because everybody was fearing a global crisis with the coronavirus. Everybody's going to need toothpaste, so that's where it's considered a safer stock. Home Depot still up, continues to be up. Haven't really done enough research into this one, but I've seen it on so many other people's pages that I know it's quite a decent stock. But before I would ever part with any money for it, I will absolutely do my own research. But just looking at that performance over time, it just looks great. We have Mondi Paper down by 9%. Poor earnings is the root cause for this. They are slowly bouncing their way back. Procter Gamble, again, another stock that would be considered a consumables, massively needed even in a time of crisis, so people will be taking hold of that. And then over the last few here, I'm not going to go into them. We have Merck Drugs, not quite sure why they were down. They're down 4%. I didn't quite catch that one in the news. Persimmon and Barrett Homes are still up because of the general election and the pledges to build houses in the Conservative manifesto, and good performance, at least definitely from Barrett, who were in the news today, saying that they'd had an extremely good quarter for house building. Anglo American is down, mainly due to, again, coronavirus in China and its effects on the mining. Nike has hovered around, did drop down $5, but is back up to back up to $100 now over fears of how far this virus could spread and if the Olympics would be cancelled or not. Bearing in mind Japan's proximity to China, it's very, very much worth thinking about if that could potentially happen. Verison's earnings weren't quite as good as people expected, so they took a slight knock. UPS has taken a knock because of the coronavirus again, and also its earnings weren't exactly spectacular either. BristolMyers is up because it's a pharmaceutical company and a lot of people are hedging their bets on them for a vaccine for the coronavirus. Aviva is down because of the perceived impact of insurance claims from potential people away, British people away on holiday, or insurance claims due to the coronavirus. We have the FTSE All World and the UK All Share. Similarly, both were down at one stage, now one's up and one's down. Largely due to, I keep saying it, that word, coronavirus. FedEx has largely been down for quite a while. I keep my eye on it because I do want to jump in when it decides it's in recovery mode, but there is some time to go for that, I think. Robotics are a very long-term look for me, so I've got my eye on 3 stocks there, but they are something I'll look into in the long term. No plans to add them anytime soon. Now, the 2 that I am seriously looking into are Johnson & Johnson because of the coronavirus effects, and like they're just a solid company all round really, without them jumping on the coronavirus bandwagon. They're just a great pharmaceutical company. They should make up a staple in anybody's portfolio. And then the Nasdaq 100 or EQQQ is going to be my slice of the tech companies such as Amazon, Google, Tesla, Apple and Microsoft. All of them are all incorporated in that one. That's going to be my slice of doing that because I really can't afford an Amazon or a Google share on its own. It would bias my portfolio. And then we have the Japanese stocks. I've been keeping an eye on these basically because I thought they would dip just as hard as the Chinese economy based on the effects of, yes, you guessed it again, the coronavirus. Cisco took a little bit of a dip. Wasn't really sure why, if I'm honest. It was on my watch list anyway, so I'll just keep it there. But before investing, I'd obviously do a little bit more research to find out that the stock price is safe. And last but not least, at the bottom here we have Kimberly Clark, again a safer stock in terms of how long it's been around and paying a dividend. They've been doing particularly well lately, back up to almost an all-time high. Earnings strong, and guess what? Their products are going to be used if people have got coronavirus. And then right at the bottom here, this is me looking at the HSBC fund for the Chinese stock market. I genuinely expected that it would dip far, far, far more than it actually did. It dropped 7%. It dropped 7% from up here, as you can see, all the way down, like off a cliff face almost. And then it's sort of bounced back up again. It's not done as bad as I thought. I thought we'd see at least a 20 or 30% drop based on what's going on in China at the moment. But because the Chinese central bank decided that they were going to release like the equivalent of $170 billion of liquidity into their stock market, they actually managed to mitigate the sell-off, and I think that's what stopped this price plummeting as far as it could have. But I will again keep an eye on it because it will even out at some point, and if I can get back in there, if I can get in there to take advantage, I certainly will. And then the momentum factor is a new notice of mine. It's the most recent on there, and it's companies that are growing and raising their dividends the quickest, and that gives the excuse me, and that gives them the most momentum and the most chance of growth. And then the money is reinvested back into the fund as well if there is any money made. So this ETF has been doing pretty well over the last year, up 20%. And then over the last 5 years, up 111%, which I think is pretty good. There's a new spot. I've just added it to the watch list. All of these are probably going to still be around on my watch list for a considerable amount of time, because there is probably well over £1,000 worth of shares there easily, and that's if I only bought one of each. What I would just like to say is I do feel for the victims of the coronavirus in China. I know we as investors are always looking to take advantage of the market and whatever. You have to realise that there are people at the end of this virus. I mean, there's 400 to 500 people sadly killed now, and well over 20,000 people infected. It's reached all the way across China. There isn't a province in China that hasn't been touched by this. And Wuhan, the epicenter, has actually lost like many lives.